Hi, my name is Steve Waber and I'm a CPA with Gelman, Rosenberg Freedman. The topic we'll cover in this short video is the state and local tax deductions and the rules and how they've changed from the past years and what the changes will be going forward. This topic is part of a series on the changes in itemized deductions. This is part 2. Part 1 was itemized deductions, your medical deductions. So this is simply our second installment of our series, and we invite you to go back and watch the medical deductions in the last section if you'd like to. So as we dive into the topic, let's take a look at the proposed form, which is still in draft at this point, which is November 9th, 2018. Hopefully you can look past the watermark. It says October 9th on it. And what you'll see here is the state and local taxes, including property taxes, are now limited to $10,000. Therefore, say you have $50,000 of state and local income taxes and $7,500 of personal property taxes for a total of $57,500. Then we read here on line E, enter the smaller of line 5D or $10,000. Well, $10,000 is your new state and local plus property taxes deduction. Now, this limitation has received a lot of coverage in the press, particularly in the high income tax states like New York, California, Massachusetts, Maryland, DC. And there's some misconceptions about it, and I'm going to try and make that understandable. Now, you might see this other taxes here. I think what this has to do with is the foreign tax deduction. You have an election you can make to either take a foreign tax credit or a foreign tax deduction, and I don't believe that that will in any way be limited by this $10,000. So let's try and cut through the politics of this piece of legislation and get to the framework for how different income levels might be affected. I'm just going to try and place this particular rule in a vacuum and see if we can get some solid results that I hope will be helpful. But in order to really help you determine the effect of this deduction on your own situation, you need to first understand a piece, and that is the alternative minimum tax. Now, whenever someone says AMT or alternative minimum tax, most people's eyes just kind of glaze over and they start thinking about what they're going to eat for lunch. This is a really boring topic, but it's really a useful topic in this analysis. So if you'll read along here, if you were in the AMT in past years, you didn't receive the deduction for state and local income taxes in the years you were in the AMT. Now, just because you were in AMT doesn't mean that you didn't get some benefit for the property taxes on your state return, but this is often the misnomer here. Oh, they're taking away our state income tax deduction. Well, anybody who was in the AMT, you never got the state income tax deduction in those years that you were in the AMT. Now, for purposes of the alternative minimum tax, the itemized deduction for state and local taxes, including property taxes, are added back to taxable income. And you're going to see this in some of the examples we do later. And that add back ends up coming into the calculation of your alternative tax. So what are we really talking about here? We're going to look at a few examples so that you can see how it works. In running scenarios, I found the group that was most affected with an increase of tax, and in the scenarios I ran, taxes went up anywhere from $1,000 to $1,500. Were married filing joint in the AGI range from the low 100,000s, 100,000 to the high 200,000s. You may see a slight increase in tax. But a disclaimer I need to make is that these projections were for Maryland residents who don't have children. And this goes back to that point I made earlier. I tried to take these in a vacuum. And what I mean by that is, if you're in this range and you have children, the child tax credit is going to greatly impact your taxes. Most people in this 100,000 to 200,000 range weren't getting a full tax credit for their children, child tax credit. Most people in this range didn't receive a child tax credit under the old tax laws. Now the changes to the child tax credit, everyone in this range will receive it. And again, we're talking about married filing joint. We can do additional analyses on single, head of household, married filing separate, but at some point you just kind of have to pull the plug. You can run analysis on this stuff all day. So if you'd like more information on the child tax credit, we did a blog post on that as well. Feel free to see it. But in general, somebody making $200,000, you had phased out of receiving the child tax credit unless you have like 8 kids. Well, now the AGI phase out, adjusted gross income phase out for this child tax credit is $400,000 for married individuals. And simply what that means is you're still going to get that tax credit. And if you have 4 kids, the total credit is $2,000 per child, $8,000. So I know a lot of people in this bracket of married filing joint with $100,000 to $200,000. Well, you may see an increase in tax based on the state and local tax deduction. But if you have children, which none of my examples include children, you're going to see tax benefit mitigating some of that loss of the state and local tax deduction. Just something to be aware of. All right, so let's dive into some examples. In our first example, which we've labeled here case 1, we have a married couple filing joint. They have no kids. Their AGI is $550,000. Again, AGI is adjusted gross income. They have charitable contributions of $15,000, state income taxes of $45,000, property taxes of $7,500, excuse me, and mortgage interest of $30,000. You're going to see case 2 here. We're not going to come back to the slide for case 2, but I'll remind you of the amounts in this example as we move on. Okay, so hopefully you can see this okay. But here's case 1. And we're going to take 2017 as our base year. This is the old tax law. And essentially what we have is all of the detail that we were talking about in the previous slide. We've got wages of $550,000, meaning our adjusted gross income in this case is $550,000, charitable $15,000, $52,500 for the taxes, $30,000 for mortgage interest. This 3% AGI floor is removed in the new tax law, but basically it's reducing the itemized deductions. We have a distinction to make between itemized and standard. What are we going to go with? Well, itemized is higher, so we take the itemized deductions, subtract them from our adjusted gross income. We have taxable income. Now remember on the slide where I talked about the AMT, we're going to have an add back to taxable income if we're in the alternative minimum tax. So at first blush, it looks like our taxable total regular tax is going to be $127,000. But if you notice here, we've got alternative minimum tax of $9,900. $906. Now, how did they get that? Well, let's take a look over here. So here's this taxable income number. Taxable income was $459,000. So we start with taxable income. Then the way that AMT works is you add back certain preferences. In this case, the preferences were the $52,500 of real estate taxes, state and local income taxes, $52,500. Now, they're going to give you that AGI floor back. That helps a little bit. And at the end of the day, alternative minimum tax says, okay, our taxable income is $505,000. Now compare that to the $459,000 that we had over in case 1 in 2017. They say, is there any phase out? Nope, no phase out. And they decide the tentative minimum tax is $137,644. They subtract from that the $127,000 of regular tax, and our alternative minimum additional tax is $9,906. So why is this higher? Well, in essence, it's these two preferences right here being added back. So, oh no, I've been receiving the state and local income tax deduction for years. Well, if you are in the AMT, you haven't been. Now, this is a year-to-year thing. So if next year you have lower income or maybe much higher so that you class out of this 28% bracket that is the AMT, yeah, you would still get this state income tax deduction. But for this person making $550 and these are their deductions, yeah, you're in the AMT. So what happens in this case? So this particular individual, we're saying that he has withholding of $140,000. So his net federal tax due is $344. Now we're not going to go into the state, but it looks like he's got some state withholding. This is the $45,000 of state withholding plus the $7,500 of property taxes equals that $52,500 that's being deducted here in itemized deductions. All right, let's get rid of all of this writing and let's talk about now 2018. All right, so in 2018, the tax rates have been reduced. So this person still has the $550,000 of wages, same charitable contributions, $10,000 of state income taxes. Well, he doesn't really just have $10,000 of state income taxes, it's being limited to $10,000. He still has the $52,500, but for purposes of the federal tax return and Schedule A, which we filled out earlier in this presentation, he's down to $10,000. He still has the mortgage interest of $30,000. His itemized deductions are higher than the standard deduction, but wow, he is down here almost a full $35,000 in his total deductions. So this is going to hurt him, right? Well, no, because the tax rates have become much more favorable. His total regular tax is actually down $3,000 from 2017. And then what happened to the AMT here? Well, there's no longer this net alternative minimum tax hit. There was an add back of $10,000 for the property taxes, but after doing the entire calculation, his alternative minimum tax was lower than his regular tax. So there's no AMT hit. So at the end of the day, this person with the exact same facts, the exact same circumstances, is paying $13,000 less in tax. So the Tax Cuts and Jobs Act for this particular taxpayer is giving them a full $13,000 back. That's real savings. All right, so that's the 550. If we erase all of this work again and we move over to case number 2, quickly I'll just go through this taxpayer, married filing joint, making $350,000, $15,000 in charitable contributions, $32,500 in taxes. This is $25,000 in taxable state income tax, $7,500 in personal property tax, $30,000 mortgage interest. We have that 3% AGI floor again. They're being picked up in AMT as well. We could go through the same calculation. I'm not going to bore you with it again unless you really want it. The net federal tax due, in this case, we have him withholding $70,000, so he's getting $1,000 back. But this is the important number right here. His federal income tax, $68,971. Take this taxpayer who's earning $350 a year through the exact same calculation, and they are saving about $8,700 on the new Tax Cuts and Jobs Act. All right, cases 3 and 4. I decided to only go through 4 cases. You know, we could do quite a few more. And you know, if you respond to this blog post and say, hey, we'd like this set of facts, you know, I can run a couple more scenarios. But you know, if this is something that really interests you, call us. You know, you'll see my email address, my phone number at the end of this presentation. If you're curious, feel free to reach out. This is just to kind of give you an indication of what's going on. So in cases 3 and 4, we got married filing joint, no kids, making $150. They have state income taxes $10,000, property taxes $7,500, charitable contributions of $15,000, and mortgage interest of $20,000. Again, case 4, we're not going to come back to this slide, but I'll remind you of the facts and circumstances in this case as well. Okay, so this is our cases 3 and 4, and as you can see here, as we discussed in the last slide, we have wages of $150, we have charitable contributions of $15,000, state and local taxes and property taxes of $17,500, which is the $7,500 of property tax and the $10,000 of state and local tax. And we've got interest expense of $20,000. So this individual is not in the AMT. You can see over here to the right, we don't have an AMT tax calculation for an individual in this wage range. And you can see at the bottom of the screen here, he's in the 25% tax bracket. Typically AMT, you're in the 28% tax bracket. We run down through the calculation. Again, our itemized deductions are higher than the standard, so we're not going to take the standard, we take the itemized. And our taxable income is $89,400. Apply that to the tax rate, and this taxpayer is paying tax of $13,834. Take the same scenario in 2018, and the main changes here, we've lost $7,500 of taxes because of our tax limitation that we saw on the previous slide on Schedule A. And we've lost the personal exemption. One final change is we've lost
or we've reduced our tax rates by the marginal tax rate he's now in is 20%, 22%. So what's the effect? Well, the reduction in tax rate is actually not enough to make up for the loss of the personal exemption and the state and local tax reductions. And so he or she ends up owing $1,000 more than in prior years. This is probably a good place to mention the caveat that this is for married filing joint, no kids. So this taxpayer and spouse, if they did have children, say they had 2 children, they would not fall outside the phase out of $400,000. They would have a $4,000 child tax credit. Now, the personal exemptions, if they had 2 kids, would double. So this would be $16,200. So the total reduction in tax here would probably be something more in the range of $2,500 to $3,000. And over here they would end up with a $4,000 tax credit. So they could see themselves actually making out better if they had kids. But again, this is another kind of scenario that we could run. If you contacted us and said, hey, you know, your scenario case 3 mirrored mine pretty closely, but we have kids, we can factor those in, and that can help you to really get a good gauge on what your tax effect is going to be under the new tax law. So this does support our assumption in the previous slide that talked about, you know, who's going to be negatively affected by the state and local tax reduction if we were to take it in a vacuum. And that is families that make from the low $100,000 range up to the high $200,000 range. Basically anybody who doesn't get stuck with AMT in 2017. So moving on to our final scenario, we have a taxpayer who now is making $1.5 million, and he has charitable contributions of $15,000, state and local taxes and property taxes of $127,500, which is the $7,500 property taxes plus the $130,000 of state tax withheld for $137,500. They have $30,000 of interest expense, and then there's this 30% AGI floor, which we'll talk about in episode 5 of our series. So stay tuned for that. After applying the taxpayer's 40% nominal federal tax rate, they come out with a $481,000 tax. If you look over to the right again, there is no AMT adjustment because the regular tax is a good $78,000 higher than the AMT tax. So no AMT. You can see these 2 cases are for individuals who class out of AMT, one because they don't make enough and the other because they make too much. So we have a final federal tax due for the taxpayer in 2017 of $492,000. Moving on to 2018, this taxpayer loses $127,000 of state tax deductions because of that limitation to $10,000. Well, this guy has got to owe more money, right? Well, actually, they don't. And the reason is because the effective tax rates have dropped quite a bit. So apply the lower tax rate to this higher income taxpayer, and they're actually saving about $6,300. in this scenario. So that gives you kind of a wide-ranging spectrum of the different income levels. We talked about 550,000, 350,000, 150,000, and 1.5 million. Again, we can run any kind of scenario for you. So if you'd like something that we didn't touch on, just get in touch with us. We can help you with that. That's all for our topic today. As always, you can reach out to me anytime at espoir@grfcpa.com. You can call the firm's phone number and dial my extension 671. If there are any scenarios that you'd like us to run, you'd like us to become your new tax preparers, we would typically tell you we need your last filed tax return. This makes it very easy for us to run projections for you. Again, this was the second installment of our 5-part series on the changes to the itemized deductions Schedule A from the Tax Cuts and Jobs Act. Episode 1 was medical deductions. This was episode 2 on state and local plus property tax deductions. 3 is on mortgage interest. 4 will be a charitable contribution. Changes to the charitable contributions and ideas for planning with charitable contributions. And 4 is the removal of the 2% AGI deduction, unreimbursed business expenses, the casualty loss changes in the casualty loss rules, and a little bit more detail on the 3% AGI phase out that has been removed. Again, thanks for listening and have a great day.